Okay, I believe, yep, you can hear me. My microphone is working. Okay, I'm a happy little camper. So, we are going to be working with chapter 23, which is talking about variances and standards. Now, the easiest way I can describe this is that I'm going to go look at, okay, what do I think it's going to take for me to create some type of product, whether that is going to be price and quantity that I take into consideration, labor hours versus how much I'm going to pay a person, and then of course my factory overhead. So we are going to be looking at a budget. I like to call the standards a budget. It's not a budget per se, but it behaves like a budget. And then we look at the variances, which is when we look at our standards, this is what we think it should be. And my actual, this is what really happened. And we're going to find, especially in this dynamic environment that we have right now, this dynamic economy, we're going to see there could be a lot of different variances. And let's take that next step and explain to our managers, why did this happen? Why do we have a variance? Is it because I hired a bunch of new people and they didn't know how to work the machines and they ended up wasting a bunch of my materials? Is it because maybe some vendor sent me over some yucky materials because they didn't have anything? Did it take me longer? Did my employees have to take more time in preparing these products? There's something that we've got to figure out, and we need to be able to explain it. And that's what we do. We're all about telling you what's up. Okay, so what we're going to do is we're talking about standards and how they're established. We're going to talk about how standards are used in budgeting. You know, right now I'm like lifting my fingers up and I'm doing the little air quotes, okay? So just picture that. Okay, then we're going to compute and interpret direct materials and direct labor variances. Very easy to do. And I have a spreadsheet in the Canvas to help you with that. Remember, you can't break my spreadsheets. You can just go and just download them again. Use Excel. Become Excel's friend. It's your best friend. It wants you to come over. It wants you to create pivot tables and make everything pretty, okay? Get used to it. Okay, so then we're going to look at factory overhead, which we have controllable and volume variances. We're going to talk about how we can report standards and variances. We are also going to go into the service setting and look at standards and variances and how we can do that in the service industry. And then we're going to compute and interpret revenue variances, which, you know, we always hope they're positive, but we'll see. So basically, standards are the performance goals. You got to be careful when you create these standards. You don't want a standard that's too tight, meaning that everything is absolutely in perfect manufacturing. You don't want to do that because guess what? Life isn't perfect and you're going to come across some type of problem. Maybe your machinery breaks down. Maybe you have to go out and you have to hire some new employees, and these employees are more skilled and so they require more wages. You know, there's all kinds of variables that can happen. And so you've got to take into consideration, okay, I need to set my standard, but not set it so tight that it's impossible to meet. And then we got to go the opposite direction. I've got to set my standard, but I can't make it so loose that I'm going to always meet it, and I really don't have to do anything. I don't care. I'm just going to do my job and go home. No. You've got to have it right in between, something that is attainable, something that's going to make you strive to save money in the manufacturing cycle. Okay, so I've already kind of went over that. We're going to focus in on direct labor, direct materials, and factory overhead, all of our cost of goods sold. Okay, so here, I already kind of went ahead because, squirrel, I'm just all about that. We have our ideal standards, which are perfection. Not going to happen. Perfection, last time I heard, those machines don't walk on water. So just take that out of your head and start thinking about normal. What can I realistically attain? So that's what we're going to do. We're going to find those normal standards because we're just a bunch of normal accountants. Okay, so I'll tell you my criticism. My criticism of standards is I don't like the accounting for it, because in the standard costing system, they want you to create these different GL accounts, and it makes me feel icky when I use that methodology in accounting. I don't like how it flows. To me, it's easier to create a report and say, hey, this is why we didn't meet these standards, instead of looking at a bunch of GL accounts and then trying to explain it to somebody who has very little accounting experience. And they're going to be looking at these numbers going, why is this? And no. I'd rather just explain it in a report instead of having people look at my ledger. That's just my humble opinion, though it's not so humble. Okay, so standards, they're talking about in here, they're talking about the dynamic manufacturing environment, which right now it's happening. I mean, you look at our gas prices, they're going through the roof. Don't tell my husband, but I was messing around, and when I was going to buy my son's ticket from LA to Yuma, it was like, it started out being like $100. And, well, anyhow, I didn't pay $100 because I waited too long. But these costs that are increasing, and they continue to increase. Like in California, you're going to pay $5 a gallon for gas. Who'd have thunk? Here it's $4. I still don't like it. I went to go see my friend in October. You guys all know about that in Phoenix. And I was driving out from Goodyear, and I stopped and got gas, and then I drove through Gila Bend, and believe it or not, gas was cheaper in Gila Bend. I was like banging my head on the dashboard. Anyhow, so there's all kinds of things that you can take into the fact when you have such a dynamic environment. In this case, they're talking about with standards, you can lose focus on just focusing in like a tunnel vision. I'm only going to worry about this. We got to meet the standards, and there's nothing else I care about. Just meet the standards. So you're not looking at how can I go past just meeting the standards and maybe find other ways to cut cost. I'm a big fan of continuous improvement, always looking at ways to increase your efficiency, lower your cost, and of course, increase your profit. That's my personal choice. Some people may want to argue with me, and that's fine. They can, and we'll have a good argument. So let's continue on. Okay, so here's our knowledge check activity. Which of the following is a major objective in setting standards within a standard cost system? Making employees work as quickly as possible. Yeah, that doesn't work for my kids. Producing as many products as possible during the period. Motivating employees to achieve efficient operations. And then I want to fire the managers who are responsible for unfavorable variances. Well, that would be kind of stupid, but which one do you think is a good major objective in setting standards? Well, yeah, I'd like my employees to work as quickly as possible, but I don't want them to make mistakes and potentially harm themselves or cause damage to potential product. Producing as many products as possible. Okay, then if I produce as many products as possible, I come into the case where I'm doing it so quickly that my quality control may decrease. Okay, not everything's a Twinkie. We all love our Twinkies. Okay, I like motivating employees to achieve efficient operations. That's my preference. And then, of course, the firing managers who are responsible for unfavorable variances. It's probably set up into the contract that they get so many times to mess up and then they're fired. but who knows? Look at C. Yes! Can you believe it? Your instructor knew the answer. Okay. So here's my budgetary performance evaluation. We have already worked on a master budget. You know what that looks like. You know how we start off with, how many units are we going to want to sell? How much do we want in our inventory at the ending inventory? How much do we already have in inventory? And we look at all of those different pieces and then build a huge budget upon that. So that's what we first need to do. What we're going to do now is we're going to look at blue jeans. And I don't know, I've never heard of Western Writer Incorporated, but that's because I grew up with Levi's. So standards for direct materials, direct labor, and factory overhead, we're going to separate them into two components, the standard price and the standard quantity. And let's check this out. So look at that. Standard cost per unit. Standard price multiplied by the standard quantity. Now, what you're going to see in here is you're going to see my standards. My standard price per square yard. And this is my direct materials. This is my jean materials. And normally the standard pair of jeans, I guess it's an extra large jean, is 1.5 square yards. It's going to take my people 0.8 hours. And we're going to pay them really crappy at $9 an hour. And then my factory overhead. Now check this out. Remember our drivers. So I can tell right here that when I'm looking at this, that what's driving my factory overhead allocation is going to be my direct labor hours, or my DLH. So my standard is each of my pairs of jean should cost $19.50. That's just the cost of the product. Okay. Okay, so what happens when we have things that, don't meet the standard? I come in over or under. Again, I'm going to have to do something, and I like to call it managing up. And what we're going to do is we're going to explain to the powers that be, probably, our boss, the CEO, whoops, went too far, CFO, whoever it may be. I may be going over to the plant manager and saying, hey, look, based on this, we're not meeting the standards. Let's talk about what we can do to cut these costs. So favorable is when we come in under the standard, unfavorable is when we go over. So here, the report that summarizes actual cost, standard cost, and differences is called the Budget Performance Report. Again, remember, these are not GAAP reports. GAAP reports are required for external users. This is an internal user. This is somebody within the company who's going to be looking at this report. They don't care that it's not GAAP. They just want the pertinent information so they can make good decisions. Okay, so here we go. We have got 5,000 pairs. Here's my actual cost, 40,000, 3,8,500, 2,2,400, 101,050. Okay. So if I looked at this, if I took 5,000 and multiplied it by 1950, what do you think I'd end up with? What's the dollar amount? Well, let's think about that. Okay, so here is my little budget report. And I'm going to sit up straight in my chair. Okay, my actual cost, 101,050, and my standard cost, 97,500. And you can see the difference here. You can see that, okay, my direct materials came up unfavorable, so did my labor. Now my factory overhead went under. There's a couple of reasons that may happen, and we'll look at that when we get to factory overhead, which I don't like. It's blah. Okay. Total manufacturing cost variance. When I look at my direct materials, I'm going to be looking at the quantity and I'm going to be looking at the price. Direct labor, I'm going to be looking at the number of hours and I'm going to be looking at the wage cost. And then factory overhead, I'm going to be looking at variable. And then I'm also going to be looking at fixed factory overhead volume variance. And that one right there is when, you know how you take your fixed factory overhead. I have 100,000 units and I have budgeted my predetermined factory overhead rate. I have said, okay, I'm going to have 10,000 direct labor hours. That's my budget. I divided into that 100,000. So each of my factory overhead direct labor hours gets like $10. Well, I'm making the assumption 10,000 hours based on a certain quantity of parts or whatever it is product I'm producing. And there could be that I'm assuming 100% capacity in the manufacturing process when in fact I don't have 100% capacity. I created my predetermined factory overhead allocation rate on 100%, but I may have only obtained 80% in the real world. So I'm not going to be taking that fixed factory overhead and allocating it across, let's say, 1,000 units. Instead, I'm going to be looking at allocating only 800 units. So I'm not going to get all that fixed factory overhead to the product, all that fixed factory overhead cost to the product. Okay, if you could see my hands going, they look like flying around a mile a minute. Okay, so here's some fun, really cool formulas. Yeah, blah, blah, blah. Okay, let's go and let's check out to see what happens here. Now, I do have a spreadsheet in your Canvas that will help you with this. So, I'm not too worried about this, and I'm going to try to cut some of my time down by just kind of going through this pretty fast. Okay, so which of the following is not a component of total manufacturing cost? Which one do you think it is? They all sound very convincing. Well, I do know there is a direct materials cost variance. I do know there's a direct labor cost variance and a factory overhead cost variance. Now, this one right here doesn't talk about being a factory overhead. They're just saying fixed and variable. And so I'm sitting there thinking in my head, okay, I could have fixed cost in my factory overhead. I could also have variable cost in my factory overhead. My direct materials normally are variable based on my production level. Same thing with my direct labor. I'm kind of wondering if they're trying, that crazy man sitting up in the tower with the big glasses, if he's trying to trick me with the words. So let's find out. And yes, he is. He's trying to trip me up. Oh, crazy dude. We're just not going to let him do that to us. Okay, so let's get in here and let's look to see if there's a price variance or a quantity variance. And we're going to take these into account for each of these. So we're going to look at our materials, we're going to look at our labor, and figure it all out. Okay. So my variance, my actual cost is $41.50. Standard was $37,500. Difference of $2,650. So how did that happen? Well, my actual price was $550 per square yard times 7,300 square yards. Okay, that gave me my $41.50. Then down here, you can see it right up here. Down here, I've got my $5 and 7,500. So right now, you already know we've got some variances. So here, our actual price was $5.50, where our standard was only $5. So we know that's going to have an impact on this difference. And then look at this. We only use 7,300 square yards, but our standard is 7,500. So we use less quantity. So how does that relate? Let's figure it out. So direct materials price variance, you take your actual price minus your standard, multiplied by your actual quantity, and that tells me I have $3,650 unfavorable. Okay, but my quantity, that's just my price, my quantity, I use less. So let's check that out. I take my actual quantity minus my standard quantity. 73 minus 75, multiplied it by my standard price. and that's a negative, so that's a favorable variance. So then I take the two, the price and the quantity, I add them together, and I get my answer, which is right there. That's pretty easy. So let's go ahead, and I think I'm going to stop. I'm going to make a part 2. I'm going to stop after I get done with the labor, and then we'll get into factory overhead. Okay, so how do I report? Well, I can say, hey, you know, somebody didn't go and they didn't oil up that machine that was making my tortillas, and so the wheels or the components in it got messed up and it wasn't heating right, and so my tortillas didn't come out perfectly circular and have that nice beautiful bubble on it, you know, when it heats up. You know, I've got to have my tortillas. So that could be it. It could be that maybe I just got, okay, I'm trying to think of something that, maybe I bought generic food product, and I'm one of those that was raised to think that if you bought the store brand, it's not as good. Like, I have a hard time buying the store brand because I think it's going to be of inferior quality. So let's just pretend that I bought inferior quality flour and lard and baking soda, whatever else I throw into those tortillas. And they just didn't turn out as nice. We all know, you know, if you've got to do like your tamales, we all know that you got to make the tamales the right way, or else they're just not going to taste that great. You got to get your grandma in there, and she's got to teach you how to make that masa beautifully, fine, smooth like silk, in order to have an outstanding tamale. Okay, so not all variances are controllable. Let's say, for example, there was a time about 7 years ago when the lumber industry, they were having a hard time with going and cut down the trees and getting the lumber to us, and prices for lumber went way through the roof. You have no control over that. There was a time, okay, back in COVID, all of that work that everybody did, you know, trying to get the products to us, and we're still having problems. Like, somebody told me it took 2 years to get a garage door replacement. My friend Trace up in Phoenix, she had a component on her vehicle. She's got a Volkswagen. She's got a Volkswagen vehicle, not a VW Bug. So a component broke, but because of the component, and there was a backlog on making those components, so it took her like 2 or 3 months to get her car fixed, and it wasn't drivable, because they didn't have any inventory, and we're seeing a lot of that problem right now. I know that in the construction business, they're having a hard time with like fiberglass products, you know, shower doors, showers, bathtubs. They're having a hard time getting those products in to the stores so they can purchase them and then take them out on the construction site and put them in. And so that's causing a lot of delay. Of course, you got supply and demand, and that's going to have a lot of fun with it. Okay, so we'll just keep going on. Direct labor. Okay, actual is 38.5, standard is 36, difference of 2,500. My actual was $10 an hour at 3,850 hours, where my standard was $9 an hour at 4,000. So again, my actual came up $1 more than my standard, but I used less time, 150 hours. So let's see how that relates in here. So we're going to look here, my direct labor rate. So I'm going to take my actual minus my standard multiplied by my actual hours. That's 3,850 unfavorable variance, but that's not, it's only 2,500. So let's see what that time did. So I take my actual direct labor hours minus my standard multiplied by my standard, and we can see 1,350. Okay, that's favorable. I got to save some time on that. And combine the two, 2,500. Yay! Can we see what's over here? Again, what happened there? Well, in this case, we used less hours and we paid our employees more. So maybe I brought in more seasoned employees who knew what they were doing and they could work efficiently and they saved on their time. However, I still paid them more. I don't know. It could be a variety of reasons. They're talking about turnover here, but that's not what happened in this case. So I'm not even, you can read that and see it in your PowerPoint. And I'm going to move forward. Okay, for non-manufacturing activities. We can do that. In fact, we do it all the time in accounting. You guys just don't know it. There's all kinds of things that we do in accounting that don't necessarily have to deal with the finances. It's still, we're accounting for physical activity, but it's not necessarily something that I'm going to report in my financial statements. I know of cases where I can go in and I can look and run reports in my computerized accounting program and see how much work people are doing. So I go, and let's say I have a number of accounts receivable clerks or accounts, let's just say accounts receivable. That's good. And so I've got 10 accounts receivable clerks. On average, my clerks can get in, let's say, 5 invoices per hour. Now, I can run that report and I can look at how many invoices. Of course, I'm going to have somebody that is performing like over the top because they're just good at typing and they know what they're doing. And then down here at the bottom, I may have people who are underperforming. And so I'm probably going to run some type of statistical analysis on it. I'm probably going to do a standard deviation where I'm going to look at what the median is, not the mean, but the median. Where exactly half of the people are above this point and half of the people are below. And I'm going to look at how many standard deviations are out there. So remember, standard deviation, 67% of your population should fall between one standard deviation to the left and to the right of your median. And then I believe it's 95% or 2 standard deviations. And then I think it's 99 point something or 3 standard deviations. So my population, if I see that I've got somebody falling way out, let's say in the bad area, beyond, let's say 1 standard deviation, and maybe they're 2 standard deviations, I can tell they're having a hard time. Now I got a couple options here. I can terminate them and get somebody else in to do the work, or I can train them up and work with them to try to improve their work product. So we do watch this information. I know a lot of you have probably worked at call centers. They watch your phone calls. You have so much time to get off that phone and take a new phone call. They're watching you, and they're timing you, and they're judging you. And there's reports coming out, and they're doing the same type of analysis that I'm talking about, but they're doing it for the call center. So it's just some things for you guys to think about. Okay. Oh, we're not doing the discussion. Okay, share our thoughts. No, don't do the discussion, Professor. Just leave it alone. Okay, you convinced me. Okay, I'm going to go ahead and stop here, and I'm going to pop back in and start a new video. So I'll just see you in a couple moments.